Hi, I'm Adam Sussman, Director of Research at TABB Group, joined by Larry TABB, CEO and founder. And today we're going to be talking about financial and industry compensation practices. You know, Larry, despite some of the stalling of the larger financial overhaul, we continue to hear cries both here and in Europe about, trying to regulate compensation across the industry. What are your takes on what the first steps towards that are going to be?
Well, there's certainly a lot of uproar around it. The regulators are feeling pressure from the general population. We're starting to see folks like the president or the CEO of Goldman Sachs, like Blankfein, basically saying, "Hey guys, there's going to be bonuses. Keep them modest." There's been some interesting viral videos around that, and there's been basically a lot of uproar against it. Now, you've got what's happening is that the yield curve right now is very steep. Short-term interest rates are extremely low. Long-term or longer-term interest rates are not so low. You're going to see the firms that are not in significant trouble have tremendous earnings out through the end of the year, unless there's another crisis, God forbid. And so these firms right now are earning on a pace to almost be record years. So there's going to be a ton of money. But the issues are going to be they're not going to be able to pay out as much cash. There's going to be moves towards making this more, giving them stock and giving the firms clawback capabilities. And so to a certain extent, their firms are going to be generating a lot of capital. They're not actually going to be able to write checks out that are as significant as they have done in the past. There'll be clawback procedures. There'll be more stock and options given out. And I think what will wind up happening is that some of these larger firms are going to wind up with significant bankrolls that you're going to see. And it'll be a very interesting year to see what happens with those bankrolls.
Now, one of the issues that have been brought up in the past when you start compensating people in terms of stock instead of cash is that it actually dilutes, the earnings of the rest of the shareholders. So do you think that this is a good thing for financial services companies, or is this a step in the wrong direction just to try to, put to rest some of the concerns?
I think generally it is a step in the wrong direction. I think that certainly employees within firms should have some sort of incentive to make sure that the company goes further. Certainly there needs to be some sort of clawback mechanisms to make sure that, if I've generated a lot of risk in the longer term, I don't get compensated all today, and then the firms implode. But on the other hand, these are competitive industries, and you're going to wind up seeing the firms that are under less competitive or less regulatory threat and challenge wind up being able to compensate employees in a different manner than the firms that are under larger regulatory challenge, and those ones that are under a larger regulatory challenge will wind up then being impacted very severely for the longer term, and I think that'll be a challenge. Now, one of the interesting things that might wind up coming out of this, actually, if these firms have fairly large war chests and can't actually write checks for bonuses, what are they going to do with that cash? And I think one of the interesting things might be is that there might be actually a wave of investment. So they're going to have war chests of cash. They're not going to be able to write all these checks, and they're not going to want to give it to the government, and they're not going to necessarily want to give it all back to the shareholders either. And so I think what you might wind up seeing actually is after a year and a half, or 2 years of starving investment, you might see another investment wave in technology and other issues, other businesses.
That's interesting, right? Because one of the unintended consequences then of basically forcing or encouraging companies to build this war chest would be another wave of consolidation in the industry, which would just create entities that are, again, too big to fail.
Well, the too big to fail issue is absolutely an issue, and I'm not sure how you get around it. We've pumped billions of dollars into these organizations, and the question becomes do you keep them going? Do you make them larger so that they're harder to break apart, or how do you wind up sending them to logically break apart? And unfortunately, I just don't have the answers to those questions. I think we'll have to wait and see what happens with regulatory overhaul and other issues.
Right. Well, thank you very much for the insight. We'll certainly keep our eyes peeled for Wall Street bonuses in the months to come. This has been Adam Sussman, Director of Research at TABB Group, CEO and founder Larry TABB. Thank you very much.